Welcome and hello. Welcome to the Go Plan video library that includes Greenleaf Financial Fitness Series and other financial professional series involved with personal financial wellness. This series, along with other videos, will be posted on our Go Plan YouTube channel, websites, and other social media outlets. My name is Jim Hiles, and as your host, I think it's important to highlight what financial wellness is and how tools like Go Plan 101 can help Americans achieve their goals and wishes. So, what is financial wellness? It is defined as the overall financial health of an individual. What it does for you is probably most important. It helps you increase understanding all things related to money. It can also help decrease stress, help you make better decisions, and perhaps most importantly, keep you on track as things change in the future. What's Go Plan 101? Well, Go Plan 101 combines web technology and educational content with behavioral change solutions, free software, and a huge resource center full of focused responses. Translation? Simple. Go Plan 101 is a cool site that helps people deal with their money issues so they can do what they want to do. And you also have the capability on our site to talk to a coach or go right to the resource. At the end of the day, financial wellness is only as good as the actions taken. So sit back, relax, and enjoy the video.
Good afternoon and welcome to the Greenleaf Financial Fitness Series powered by First Capital Advisors Group. 20 minutes to a healthier, wealthier you. Today's webinar, we'll be talking about life and disability insurance and protecting your assets. We'd like to start out with our usual cast of characters here that make these webinars happen. Up top, we have Jamie Greenleaf. Jamie is a partner and advisor with Cafaro Greenleaf. Jim Hiles here with me today. Jim is a senior partner with Greenleaf Financial, and I am Jim D. I'm a financial advisor with Greenleaf Financial. Okay, so let's get into it. Financial security starts with protecting income and assets, actually. So let's take a look at our financial pyramid here. In the middle, we see things like retirement plans, personal investments, savings accounts, ownership in business. We could also include real estate in here. And then underpinning these assets, we see the insurances that we use to protect them. So that protection gives us peace of mind. And underneath all of that, we can see disability insurance, which underpins all of the other items above that. And today we're going to be focusing just on strictly the life and disability. In the event of a death or a disability of someone who's earning income, the question is, how are you going to replace that income? And here we have a list of pretty much the only ways you can do that, which are things like personal savings, retirement accounts, and emergency funds if you have them set aside. Of course, if there's a spouse who's working, can the spouse continue to work or work more to replace that missing income? Of course, insurance, which we're going to be talking about today. And then after that, you have loans or from a bank or loans against credit cards, which are really not ideal, of course. So let's look at life insurance first. Basically, life insurance is the best way to protect against the financial consequences of a premature death. However, what we see is only about 60%, 6 out of 10 Americans actually own life insurance. And half of the people who do believe that they don't own enough. That's a concern. So now let's talk about the different types of life insurance. And I'm going to bring Jim Hiles in here. Jim, why don't you tell us about term?
Well, that's an exciting thing. I know it's the holidays, and we get this first day, happy holidays to everybody out there. It is December after all. And here we're ending up the year with the end of life scenario, I guess, with death and disability. So how exciting.
End of the year. There you go.
So let's go ahead and get into it, because it is a subject that a lot of people just tend to not want to talk about, but you need to take some financial responsibility and dive into it. And we're going to talk about life insurance. There are different types of life insurance, and I think the life insurance community has made it as difficult as possible to actually understand what's going on. So I'm going to do my best today in a couple of slides to kind of break it down for you. We're going to start with some of the basics. So this is term insurance. Term insurance, think of term insurance like renting insurance. If you die and you're paying the premium or you're paying the rent, then you're going to get a death benefit of what you intended on purchasing. If you're not paying for it, generally, it's not going to be there for you. So term insurance is the simplest form of life insurance. It is what we call pure risk, which means you pay a premium and you're insuring for a certain period, term, and therefore it only covers it during that period. Well, in that particular scenario, you need to decide, what you want to buy, how much premium you want to pay, and then the beneficiary, should you pass away in that period, they'll get the beneficiary, whatever death benefit is. There is no payout. There is no cash value buildup. There's really no value at all to anyone during the life of the payment of that policy. And the term insurance is actually a very flexible thing because you can buy it for 1 year, for 5 years, 10, 15, 20, 25, 30-year length. So you can buy what's called a 20-year level term insurance policy where you have a level premium for 20 years, typically guaranteed for 20-year period. So you know what that is. You can budget for the amount of insurance that you need over time, or you can buy it for 1 year and just pay year by year, depending on what your needs are. Generally, you look at term insurance because it's a low-cost option. And if you need life insurance for only a certain period of time, like you want to make sure you're covering in the event of death on your mortgage, for example, you want to make sure that's paid off, but your mortgage is going away in 20 years, then you do 20-year term. Or kids graduate, or kids going to college, you want to make sure they graduate. Maybe you fund it only during the time they're in college. So these are the kinds of things that term insurance is designed to do.
Got it. That all makes sense. Let's talk about whole life. That's the other type, the basic type, right?
Yeah. So whole life is, so think about that for a second. Whole life. This is a policy that you're going to own your whole life and pay for your whole life. Now, I call it permanent because it's designed to be permanent. As long as you're around, it'll be around. It'll be around as long as you're around when you go. What typically happens with whole life or permanent life insurance, it comes with some sort of cash value savings element. And you may have heard of this before, where you actually own a savings or cash account that typically gets invested inside the life insurance policy. Let's talk about the three different types of life insurance and permanent life insurance.
Of permanent life, right? Because people get confused, the whole life insurance and the cash values, and then you get into these other ones that we see below here. So let's cover a little bit about how those work.
Let me just jump right to the chase here a little bit because I get this question a lot: is what should I have, permanent versus term, right? And we're going to talk about some of the differences right here. Maybe begin to see why some make sense and some may not, different kinds.
And we should talk about the old saying, right? I mean, this webinar wouldn't be complete if you didn't hear the buy term and invest the difference, right? So we hear that a lot.
Yeah, well, so let's talk about that. Let's go through why certain insurances make sense. So if you want to own it for your whole life, and what that means is term insurance generally is not available post age 75. Maybe you get up to 80, but the life expectancy for most people is beyond age 80 and actually getting up to the 90s. So you're not going to probably have term insurance much beyond retirement or much into retirement. So if you're looking at having something which is going to be there for your whole life, you look at whole life insurance where the premiums stay the same for your whole life. You're paying more, a lot more than term insurance in the early years. But on the other hand, it will accumulate cash value. It'll be invested in the company's general investment portfolio with the insurance company, and that's going to start to compound. Over time, that cash value could be a source where you could tap into it. You could use it for retirement. You can borrow against those cash value policies and actually take money out for supplementing your retirement income or for one-time needs or whatever. Or you can just surrender a policy if you have no more need to it and take the cash out. So that's what whole life is. There are different varieties of permanent insurance. Let's talk about universal life. Whole life, the problem with whole life insurance, you had to pay the premium every single year. You had to pay the premium. Well, universal life came out and they basically said, we don't care. Just pay enough into the policy based on your cash flow. So what they did with universal life is they gave you greater flexibility to fund. You could put in a little or a lot depending on what was appropriate for you. Maybe your cash flow is a little different in given years. Maybe you had a little more this year you want to put in. You had less next year you can't put in. Universal life was built for that.
So if you pay less, obviously your benefit is less.
No, benefit's the same. All they want to know is that there's enough money in there to accumulate cash value to keep the policy going. That's all that the insurance company is looking at that point. If there's not enough money in that account, it will expire before you will. So that's one of the issues with universal life is, hey, we give you the flexibility, enough rope to hang yourself if you're not careful.
Right. So that's what you got to be careful about.
Yeah. Variable life. Let's talk about variable. What does variable mean? Basically, what happened, I don't know, 20, 30 years ago is the consumer said, well, I want to invest the money that's in the cash value of my insurance policy. Well, with variable life insurance, that's what they allowed you to do. You can invest the cash value into stock funds, bond funds, all different types of mutual funds. It kind of looks and feels like a 401k plan. Your cash value inside an investment vehicle, in this case, an insurance cash value, where you can invest those monies. Now, keep in mind, the value of the policy can grow, but can also go the other way if you're not careful. So this is a way for the consumer to have more control over the cash value inside their life insurance. It's up to you in terms of how you invest it in terms of performance anyway.
Okay.
So let's cover, so that was a quick, second or two on the details, but basics here. Death benefits of life insurance are typically tax-free. So when you pay a premium, the death benefits received for all types of term or permanent or whole life or variable, what we just talked about, are generally income tax-free to the beneficiary. So that's one of the main benefits of life insurance. With permanent cash value life insurance, you actually can build an asset that you can use throughout your lifetime. This cash value can grow. One of the benefits of investing inside a life insurance policy is the cash value can grow tax deferred. There's no tax on the inside buildup, if you will, on the growth of the policy. And when you take the money out, there are no contribution limits or early withdrawal penalties or no income tax on the money when they pass along. So there's some tax advantages to the product.
Okay, great. So that was a quick, fast and furious on life insurance. Now let's transition to disability a little bit and look at some of the common misconceptions that people have about disability insurance. And obviously, the first one is nothing's going to happen to me. I'm active. I'm healthy. I remember when I was much younger thinking this way. And the reality is we can't predict the future, and of course the future of what our health is going to look like. So most disabilities are caused by things that are unexpected. So it's although people don't think it's going to happen to them, you just certainly can't think that way. Oftentimes people feel like disability insurance, they've heard it's expensive and something they can't afford. And the reality is in many cases, people can own policies for small dollar amounts. The old adage where if you look at it, what people spend on premium coffee or dinners out, premiums can be flexible and the benefits can be customized to the specific needs of someone's budget. And then, of course, I already have coverage through my employer and or the government, which the truth, a lot of people on this call may have that or may have the ability to get it. And that's a great start. It's not always enough. And the same is true with Social Security disability benefits, which we'll cover a little bit. People may have heard about that, but those can be a challenge to obtain, and the definitions of disability can be different with those types of policies. So when we first think of disability, we often think of the causes being an injury. I mean, in my mind, it's you hear about an injury or you hear about somebody who had a heart attack or a stroke, right? But then you go into all these other, the reality is, according to one insurer and what their active claims are telling them, is there's many different reasons why people end up on disability. So if you take a look at this wheel and see that, injuries and circulatory are really only about 15, 16%. If you add them together, there's a lot of other things that could happen. And we need to be cognizant of that. So we just wanted to point that out. So let's talk about the costs.
I think it's like anything else. There's a cost and a benefit to everything, particularly when you look at insurance, because with insurance like this, you're talking about spending money now to take off risk off your table. And in this case, this gives an example of Plan A. If you get $100,000 salary and zero income, if you're too sick or too hurt to work, you could actually say, if you're disabled, if you were to buy some insurance, you might be able to replace relatively inexpensively. In this case, the example is $1,400 in a given year, which is a very standard average amount of what you could find is available for a group disability policy attached to the company benefits. You could at least get 60% of your income back if you were to have disability, and that's on an after-tax basis. So I mean, just again, look at the cost benefits of these decisions and make the decisions based on the numbers, not just based on the emotions.
Great. Now, obviously, we should point out this is not a quote; it's just a hypothetical example, right? So
Exactly.
people need to look into their specific benefits.
Yeah, I think it's up to you or whoever's on the call and the HR folks to make sure that they've got the disability available out there and they're communicating with their employees.
Right, and what it looks like for them. Okay. So Social Security disability benefits, we touched on that briefly. Supplemental Security Income Program, SSI, that would not apply to probably everybody on this phone call. It's hard to get. It's very specific in terms of it's for basically people with limited income. You have to be 65 or blind and disabled. Social Security disability insurance is more common, but again, you have to meet a very strict definition of what the government calls disability. The impairment must be severe enough to prevent you from performing any substantial gainful activity, which is very different than what you are doing specifically at your job today, right? So the disability definition is important when it comes to a policy. And
it's not unusual if you're disabled to come back to work even part-time or on a reduced basis or in a different job function. And if that were to be the case, which most people will do or want to do, actually,
right,
when you look at disability results. So this is actually, it just makes it very difficult to qualify for Social Security.
Right. So SSDI would not apply if you were able to do some type of work, just maybe not the specific work you were doing. And you also need to have sufficient work credits. You have to have worked at a job and paid into Social Security.
Right.
And if you're, just another footnote, if you're receiving SSDI and then you get to full retirement age, you then get, it switches over to Social Security income. The dollar amount stays the same, but you don't get both.
Gotcha. Okay. So how much should you have of these kinds of insurances? And in the insurance business, they call it the human life value. And I'm sure you've heard the comment, "I'm better off, dead more. I'm worth more dead than alive." Well, that's not really the point here. But the idea is to figure out how much should I have? And it's a math problem. It's not too difficult. Basically, you want to look at your income, look at your expenses. If you want to look at your years to retirement, that gives you an idea for income less expensive for a period of time. You have to take into some consideration of inflation. Average inflation might be close to 3.25%, somewhere in there, because the requirements will go up over year on average. And then there are other issues you might want to factor in here, which you want to fund a certain event like education or any other one-time costs like paying off a mortgage or making sure somebody gets some dollar amount to them for a specific cause. So you start with that, and then you move forward to, okay, so you look at your income. Now, for life insurance, you basically take out you because you're no longer here. So your cost is deducted, but the rest of those expenses still exist. So that's going to be the gap you look to fill. For disability, it's often kind of the opposite. You look at the expenses you might have to incur that happen along the way. I mean, bottom line is if you can't work, you're not producing income. And you might have additional expenses that might happen for disability. So what's left, the gap of what we call it, is what the family needs to fill.
Right. That picture reminds me of payday around here, by the way.
I appreciate that.
Throw that in.
Yeah. So basically, little calculator, and we're going to show you the calculator in just a minute. It's available on our website if you come to gfplan.com. But we want to kind of get an idea for doing just a little projection work and saying, here's what my family expenses are. I'm going to subtract any inflows that might get, like pension benefits, maybe Social Security if I qualify for it, and then add these non-reoccurring expenses in to come to some sort of dollar amount as to how much insurance I'm going to need. Sounds pretty scientific. Thankfully, we have calculators. You can go do this. It gets pretty simple when you break it down here on this screen. So here's what you got. How much money is needed for burial? This is a life insurance calculator. How many years? By the way, that number is probably lower than what I've seen in many places. So be aware that it is expensive just to take care of that.
Yeah.
How much? Okay. So how many years of income you'll need to cover? This is interesting that if you're leaving loved ones behind and you're the wage earner in the family and you want to provide a certain either level or time period, you put the time period in here. And then you put how much annual net income that the survivor needs going to be. So in this particular case, I know I want 25 years at $50,000. and I've got $100,000 in my savings and investment accounts. I have one child. The age of the child is 10 years old, and I know I want to spend money to educate my kid. I want to spend $200,000 on college expenses. Hopefully I can get it through college for that much or that little. And then any one-time expenses I want to do. In this particular case, that one-time expense is paying off my $350,000 mortgage. So, and I know that I want to do that in 5 years. So now once I have this understanding of generally how this works, I get what I'm trying to achieve, and I hit that calculate button, and down the bottom you'll see how much life insurance, which is $1.3 million of life insurance that you need in the face amount or death benefit of the policy to accomplish hitting the goals and objectives that you've laid out to take care of the people left behind. So this is how an insurance calculator works. Disability is very similar. It's going to focus more on just your income needs, not necessarily your death needs. So that's available on GF Plan. And then the question becomes, okay, if I need 1.3 million, where do I get the insurance from? Do I buy it? Do I use my group insurance that I have at work? How do I then cover this thing?
Right. It's not necessarily one policy, go out and buy it, because you probably have some already, right?
So a couple of things to keep in mind. I hear this a lot. I can't get insurance. I had a health issue, whatever. Well, all of that depends on the insurance opinions, not on your own and not your doctors. Generally, what the insurance companies will be looking at are all kinds of factors: age, health, the type and amount of insurance you have. And they're going to view your insurability over life, not given today. They're going to look at this and basically give you a price based on your risk in the marketplace. So before you assume anything, you probably should ask about your insurability. The insurance will allow you to go check your insurability out. And when you start looking at things like, where can I buy it? Group policies are available. So Jim, take group here.
Yeah, I mean, group policy through your employer is typically a much lower premium. You get available as short-term or long-term coverage, or both, and you don't have to prove insurability in most group policies. Also, on the downside, they're a little bit less flexible with benefit design than if you buy an individual policy, but they're cheaper. They'll terminate when the employment ends. You can't bring them with you typically. They're not portable. The premium is going to increase as you get older. The definition of disability may be less liberal than individual coverage, and benefits, if you do get Social Security, workers' comp, or other type of disability insurance, those benefits will be offset.
So I guess to kind of get into the wrap up here, oftentimes we do what's called an insurance audit. And basically the question is, why do you have what you have? And a lot of folks can't necessarily answer the question because they don't know exactly what their financial needs are. The other question we need to answer is it adequate? Does it suit your needs? And the last question is it cost effective? So if you need help trying to figure out what you need in this audit, then give us a call, send us an email. So we covered a lot of ground, and let's just summarize. It's time to put this information to work. We live in a wonderful and a free country, but it's up to us to take responsibility and move forward, particularly on our personal financial wellness. So let's take some action here. Let's go and explore this financial stuff. Take a buddy with you if you need to. Have some fun. Learn a little or learn a lot about what you can do financially. These videos and websites, I hope you enjoy. I think they're great. But if you're like me, sometimes you just want someone to talk it out with. So seek out coaching from our site from professionals who've been vetted to provide you with complimentary initial consultations as being part of the Go Plan 101 experience. If you've not started your planning, or even if you have, use today's video to explore the area of concentration. Make sure you understand how it impacts you. My favorite quote is, life doesn't go in a straight line. You need to stay on top of it. So consider subscribing to our newsletter or our YouTube channel. Please reach out to me if you want more help or have questions. And lastly, thank you for listening. Now, go plan and go attain your financial wellness goals. Jim Hiles signing off for today. Take care.